From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
You are listening to a bonus episode of the HPS Macrocast with all the breaking news throughout the week on the economic impact of coronavirus. We decided we should, waiting until Friday to do our shows was a little bit too much news to consume. So we'll be hosting 2 episodes each week on Wednesday and Friday to break down the latest economic news and the market implications. As always, I'm joined by Brendan Walsh and John Fagan of Markets Policy Partners. You from the hills of Western Pennsylvania. Snow this morning. We're also getting, talking about late breaking news. We got news of agreement, it looks like, on the Phase 3 stimulus bill, and we're going to get into that and try to unpack it a little bit and get a sense of what the impact will be. We started off the week with has been rolling out all of the tools in its tool chest, and maybe some tools we weren't sure were. Maybe we'll even think about what they have left. But John, why don't we start with what the Fed has done, and let's see how they're going to do it and what we think the impact will be.
Yeah, thanks, Tony. We saw the Fed come in Monday morning before financial markets opened for the trading day with an even greater magnitude of easing measures and stimulus measures than we saw before. This is, as we saw the previous week, it was 100 basis points of rate cuts, a large infusion of quantitative easing, also described as large-scale asset purchases, and this was the Fed coming in yet again. And we all saw what happened last week. The volatility remained very pronounced, dislocations in markets, and the Fed came in and the fiscal response, as we all saw, was coming together but taking some time up on Capitol Hill. And the Fed simply couldn't wait. They came riding in on Monday morning with basically an expansion of the quantitative easing program to unlimited amounts, basically whatever it takes to ease the dislocations and malfunctions in Treasury markets and mortgage markets, while putting together about $300 billion in various styles of credit support for debt markets.
I think we're losing John, but Brendan, that package that we're seeing is it's pretty massive, and it's an array. It's I think really focused to begin with on on both, as John mentioned, big quantitative easing, a lot of trying to smooth the plumbing of financial markets, right? Getting being a liquidity provider in all of these markets, the lender of last resort. So it's stepped up in a really big way. Do you think it's working?
Yes, from all indications, in terms of especially the credit markets, they're functioning more normally. Obviously, they're still under stress, but we're not seeing the same dislocations where there's just no bid. I think the biggest concern going forward is now the underlying credit, especially the commercial real estate, because small businesses just don't have the cash to pay it, and then really that's become a kind of a market where the banks aren't involved in that as much as they were pre-crisis, partially because they're not allowed to because of Dodd-Frank, but that's been picked up by a lot of non-bank lenders. So that market's never necessarily been tested under stress because it's kind of new. So I think that's a huge part of the focus that can be addressed with the fiscal stimulus, where we need to get loans to small, medium-sized, and large businesses to keep people employed and keep rents being paid.
Yeah, it's essentially what's happening there, isn't it? I'm sorry, John.
So what I'm reading from the bill, that's what the bill is. I mean, we don't have all the details, but it looks like there's a huge amount of money to address this.
Yeah, and that really speaks to the sort of dual nature of the impact we've seen. The coronavirus imposing a short-term, very acute liquidity crisis that has, the panic, the shock, the dash for cash that freezes the funding markets. It makes, even deep liquid markets like the Treasury market malfunction and trade in very gappy and disorderly ways. And that is interlocking with the slower moving but still intensifying solvency crisis, which kills you slower, but that's the answer to that is really the fiscal side of things. Certainly, the Fed came in on Monday with some specific and direct credit support, which is an early responder to the solvency crisis, which is coming down upon us here. But really, this fiscal response has to combine with the monetary response for it to be effective.
Yeah, I mean, the think about the I think about the retailers a little bit, right? So like retailers are getting obviously crushed. People can't come into their stores to buy stuff. We talked about this last week with Matt. So people can't come in if you have robust online and delivery services. Amazon, Walmart, Target, and others are doing pretty well with that. But even we saw the Target CEO on CNBC earlier this morning talking about how they're doing really well with necessities, essentials, getting demolished on things like clothing and retail. But what you're trying to do with a lot of these programs is because we've talked about this before, because it's temporary, right? It's just getting through these few months periods where you can pay the rent and pay utilities so that you don't start breaking down credits all through the financial system, right? With Tom Barrack was on earlier today. Brendan, you mentioned the commercial real estate market, which again, like you said, people don't pay a lot of attention to. But if people aren't paying their rent, they can't pay their rent because people aren't coming in to buy coffee at the coffee shop, and you can't pay your rent. You start, you get to a situation where credits start going bad, and that then you have loans that are not operating on bank balance sheets, and we know that the big banks are probably okay to handle that kind of stress, but there are a lot of small banks out there that may not be in a position to handle that. And you just end up impairing credit throughout the financial system.
Yeah, I think that's an important point where a normal landlord and renter, you could probably come up with an agreement with each other. I can pay you what I will, or when I get back up, I'll make it up to you. But a lot of the big credits are in securitized products, so that's much more complicated to just put a moratorium on rent payments.
Yeah, you can't just do we saw this in the housing crisis. You can't just do forbearance on some of those things. Those products have covenants.
It's just
you trigger covenants, and there's waterfalls on payouts, and that's the way that they're structured, and everybody now knows that going in. If they didn't know it 12 and 13 years ago, they know it now. And so that just again, like that causes stress throughout the financial system. That's what you're trying to avoid here by pumping money out into the economy.
And it also shows the Fed can help with some markets, but some markets, if the underlying credit is destroyed, there's nothing the Fed can do about that. That's where we need this big package. And $2 trillion is a nice down payment, but it might be the first of many.
And I think a really important point is, and we've discussed this in previous podcasts, but basically all of these measures are not supposed to be, they're not designed to lift asset prices. They are allowed to stave off the panic, allow markets to function more normally, and to come to a lower equilibrium, to find this level and absorb the kinds of difficulties that we're going to be having in a more orderly way that doesn't start knocking down systemic dominoes and really sort of shaking the foundations of this. That's the way policymakers look at these. They're trying to cushion the blow and keep things as orderly and basically as steady as they possibly can as markets and the economy find an equilibrium and try to find bottom here.
One of the I'd say one of the programs out there that that I don't know how it's going to work, but all of the lending programs that the Fed has done, all the liquidity provisions they've done, a lot of it are things that they've taken off the shelf from before, and we knew that they could do, and they went ahead and they're doing. The Main Street Business Lending Program that I think that the Fed and I guess in collaboration with Treasury will operate. I have absolutely no idea how they're going to do this. The Fed is built to lend to banks. They can push money and buy assets, in big markets, but it's not a bank in the traditional sense of making a decision as to whether we lend to this restaurant and not to that restaurant, or we lend to this business and not that. I mean, making that analyzing these businesses to make lending decisions, that's not their forte. And I don't actually understand how they're going to do it. I'm going to talk to some people at the Fed, but this is an important part because to get at the problem we were talking about earlier, to keep these companies functioning so that they can get across the bridge to the other side is critical, and it's one of the great innovations of this effort. I tweeted something out about this earlier today that we did send money to individuals. We did it in the Bush administration in 2008. The Obama administration did it in their Recovery and Relief Act. But this we have done help. We've bailed out sectors of the economy before, like we did with HARP, and like they're going to do with airlines here. This small business lending program, except for sort of jacking up a little bit SBA's emergency lending program, which they know how to do and do on a regular basis, something of this scale and with this speed has never been done before. And I don't really know how they're actually going to be able to do it. I don't know. Who are the people who are actually going to go and execute these programs? Or is it essentially an honor system where, you can borrow based on the size of your business and we'll audit later, but we're going to be, trusting on the front end. I don't know, because speed is so important here that I have a feeling that's the direction they're going to go.
Yeah, I've heard that they're going to have to hire BlackRock to execute it, the Fed, and that I suppose they would try to get repaid. The fiscal small lending deal that's going to come, I don't think there's any intention that small businesses are going to pay it back.
Yeah, and some of it's just going to have to and former Fed Chair Bernanke in his remarks on CNBC this morning mentioned that really working with small regional banks might be one of the tactics that they use in rolling this out, because they just have the a much more granular and better understanding of the local businesses and their credit profiles and so forth.
That's true, but if you think about the regulatory structure, even with those small banks, which may or may not be supervised by the Fed, maybe state supervised or right. Right. I mean, it's like there's this complex web of supervisory oversight. Who's the judge on whether the loan should become a grant, which is a thing that's part of this. If you keep your employees and don't if you don't lay anybody off, like a lot of this lending is intended to be essentially a grant rather than a loan. What that bank? Like there's a lot of complexity behind this that I don't know. I don't have the answer to, but we're gonna have to find out as they they're gonna have the money now, and we're gonna see how exactly they intend to do it. The other big news, of course, is that this phase 3 stimulus bill has been passed. It came in the wee hours of the morning. Why don't we come back in our next segment and dive into that a little bit and see if what we think that's going to do. You're listening to a bonus edition of the HPS Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, we're back on a bonus edition of the HPS Macrocast. So in the, I think it was like, I don't know what time it was, 3:00 in the morning or something, that Leader McConnell went to the well to announce that they had finally gotten a bipartisan agreement on the Phase 3 stimulus bill. Really critical to get bipartisan agreement. The negotiations were, Schumer, McConnell, and the White House, and Schumer essentially negotiating on behalf of House Democrats also, because the point is you want to get this deal done. The Senate is in session and in Washington, D.C., and that's critical because somebody's got to vote on this somewhere. And so the House is going to vote, the Senate is going to vote on it today. We'll dive into the elements of it. Senate's going to vote on it today. The House will, I think, probably will need until tomorrow to get enough of a quorum to vote for it under, it will essentially be a voice vote on the suspension calendar. It's, and they need to hope that no one objects to doing that by voice vote. If someone objects, then the House is going to have to come in and vote for it, which would be not just clumsy and cumbersome and add delays to this, but also dangerous. Exactly. We don't want members and staff having to get on airplanes and flying to Washington when the outcome is not in doubt. If the House came in, there's no question this thing would pass on the House floor. So the pieces of it, so there's a giant chunk in here, which is spending for that's going to go directly to individuals, $1,200 per individual. $500 per children. It's phased out at somewhere around up in the 90 to below 100,000. It phases out. If you're earning over $100,000 a year, you're not eligible. I know that a lot of people are going to be upset about that, but that's where they ended up. You have a giant $500 billion lending program. This is going to be about $75 billion to go to some larger national security interest companies and the airlines. And that's where, Boeing and airlines, aerospace industry, satellite industry, anything providing some, with anything that they consider having some national security interest. And then that leaves $425 billion for lending to small and medium enterprises and actually larger enterprises too. Actually, I think that's where you get into, some of the bigger chains and manufacturers that will have access to liquidity to get them through this period too. You have other funding in there, $150 billion for hospitals and state and local governments. We'll see when we look at the details where that all goes. But the biggest thing there is you don't want these the communities, governments that are providing sort of first responder services to people. You want them to be well funded and able to do the things that they need to do and to buy the supplies they need to respond to and solve the health issues. So that's where that's where the money is. I'm sure I probably left out
and this will be run out of Treasury
here or there. Say that again, Brendan.
These programs, they'll be run out of the Treasury.
So the $500 billion lending program will be run out of Treasury and in conjunction with the Fed. And so there's going to be a lot of Fed Treasury collaboration here on on how this money is managed and spent. It's a really big job that they have to do to try to get this money out. It's a lot of money. The House, Democrats had insisted on adding more oversight to this. We saw this when we passed the TARP bill, back in 2008. They added the special Special Inspector General for TARP, known as the SIG TARP, which I had to remind people 12 years later still exists.
Yeah.
Okay, so if you think of like these things, you do it for this temporary program. The SIG TARP still exists. Not only does it still exist, but there's a little rump group of staffers who still oversee some leftover pieces of TARP that are still out there, and these are like there's still some cleanup on TARP, really tiny stuff, and so just a handful of people who spend some of their time working on that. The SIG TARP office is three to four times larger, still exists, and is still out there doing God knows what. No one even knew. I've been telling everybody over the past couple of weeks that SIG TARP still exists. But meanwhile, Democrats have now, they have. I don't mean this is a partisan thing. I'm just saying, like they were holding out for this, adding another inspector general, adding an inspector general. I doubt that they even knew that the SIG TARP is still out there existing, and so we're going to have oversight on this. I'm going to be telling a lot of our clients and companies, be careful, record everything, keep really good notes on everything, even because you can get tripped up on things, even if you're trying to do things right. You may do things that might inspire some kind of investigation in the future. There are going to be a lot of investigations out of this. But let's talk about the macroeconomic impact of it. This is a giant bill. I don't think people really fully realize how big this is. In appropriations alone, $2+ trillion. We've never passed anything in recession response that was bigger than the $831 billion stimulus bill back in 2009. So this is enormous, and yet it may or may not be enough.
Yeah,
it's so
Senator
big.
Schumer is already saying, I think we're going to have to start working on another one right away.
What do you think it'll do? Let's say money is going out. Let's say money starts flowing out next week to small businesses, big businesses, and individuals. What do we think it's going to do?
Yeah, I mean, basically, this is trying to fill an enormous hole, and it's really keeping people from continuing to pay their bills on the individual level, continuing to meet their obligations on a corporate level in terms of debt service and payroll. We don't know how long this is going to last, and we don't know how deep the hole is. We've cast aspersions at some points on this podcast about the pace of this for Congress to come together with a bill of this size. Last week, Tony, you said they were talking about $1 trillion, and you specifically said whatever number you're talking about, double it, and that's exactly what they did.
That's what they did.
it's so you can take a victory lap on that one. But really, as everybody knows, that it's just not clear what more might be needed, and this is a pretty prompt and timely passage of a bill, and now execution is the issue. You talked about how these programs are going to work. Is the institutional machinery up to this kind of deployment? Can it get them within the kind of weeks time frame that some of these pressures are really going to start to intensify for companies and households?
I think there is some. I think it's a misconception. I hear people saying, "Well, we need to go do this bill." Do I hear kids back there, Brendan?
Yes.
Tell them we say hi.
Oh, yell at them.
I think there's a misconception out there that somehow we do this giant bill and it's going to prevent a recession, or it's going to counter the sort of
Right.
private sector estimates out there that we've seen about the depth of how deep the hole is going to be in Q2. And I keep reminding people that at least the ones I have looked at, the models I have looked at, have plugged in some kind of fiscal response. So some of these really dire predictions include the expectation that there's going to be a big fiscal response. No one is trying to prevent a recession here. There's no preventing a recession. There is going to be a recession. There may be a question as to how deep it is and how damaging it is, and how many people who are dealing with a liquidity crisis right now are going to, be tripped into a solvency crisis and end up having to, default or file for bankruptcy. So, we'll see. That's what you're trying to prevent that, but there is no preventing a recession. We're just trying to get people through to the other side, and I don't think there's a much of an understanding of that quite yet.
Yeah. So yesterday, I actually asked our friend Dr. Chris Moores, the virologist, how long we kind of really need to be shut down to get this under control, and he thought 5 weeks would be the minimum. With the social distancing at a national level, that would be. So if you kind of do the 5 to 8 weeks, I don't think $2 trillion is probably enough to get us through that. You probably have to do a couple more trillion. But then once we can't just go back and 100% reopen the economy. We still have to practice a more limited amount of social distancing. So, while people are expecting us to just immediately bounce back to 100%, I think it's going to take a few quarters before we have the virus under control where we can allow that to happen. So, I think by the end of this, we'll probably spend $5-6 trillion. And most importantly, to your point, it's not stimulative. It's just trying to fill a hole to get us through it.
Yeah. And the fact that Congress has obviously they've been wrangling about the, where to spend the money and the appropriations and basically the composition of the bill, but you haven't heard the same kind of pushback on the size. And really, and the sort of philosophical aspects, should we be doing this at all?
Yeah,
that's been good for market sentiment. We all remember 2008 and the questions about, whether a bailout should really happen. Now the questions are obviously coming up about corporates, and sort of Boeing is the main battleground, or at least the sort of poster company for this debate. What role do bailouts need to take when you start allocating, as we've talked about, this is nobody's fault. But if you have a company that was run in a way that brought on leverage that is now, whether it's, buybacks are now a big villain in this crisis already, and we're going to be talking a lot more about those. But these are the questions that are being wrestled with, much to be sorted out on that front. But yeah, in the near term, the support for households and businesses in general is a point of real agreement across the aisles.
And it's kind of a shame that we're talking about bailouts, because this isn't like 2008. Some companies were poorly run and whatnot, but the reason everybody is in this situation is because of a virus, and they what they need is a loan to make it through this. They don't need money to make their stock price go up. They just need money so that they can keep people employed and not have to go out of business. So I get worried that this becomes a political thing, and we talk about bailouts and we don't get the money to where it needs to be, because these are good loans. You want to be making these loans. These loans are going to get paid back.
They're absolutely going to be paid back, and but I'm counseling a lot of firms. I'm going to write something up on this. Just cautioning companies, because we know why these loans are being made today. We know it's not the fault of, the Gap didn't do something that put it in a position where it needs lending, and it would have been a pretty bad allocation of capital to sort of have money sitting, waiting for some pandemic to come, right? That might shut down the economy. So that would have been a great way to tie up capital for any company. So, but we know what's going to happen in the future is that, some of these companies, something is going to happen. A year from now, they are going to want to do a stock buyback. A year from now, somebody's going to lay off somebody for one reason or another. A year from now, somebody's going to have, do something that's going to upset one of the political parties in Washington, and they're going to say, you were bailed out, and now you're doing this thing, right? You were bailed out, and now you're moving this factory. You were bailed out, and you are making, you're switching from this producer to that producer. You're shutting down this factory, and even though you were bailed out, a year ago. This is what is the future that's facing, all of these companies, and it's unfair, but that's what they're going to have to deal with going forward.
And 2008 was banks, and then the car guys. This is everybody. So that's very dangerous. In 2008, the Eye of Mordor was on a few people. This, for whatever reason, you can make it an issue.
I agree. Hey guys, so here's what I'm seeing is House unlikely to vote today, but probably tomorrow. That means when we come back on Friday, we'll have the final bill. We'll be able to dive into it a little bit deeper, and maybe we'll get a little bit more details on some of these programs. So great that you guys could get together this morning for the bonus edition of the Macrocast. We'll be back, the three of us, on Friday, and we'll dive back into what this bill is going to do and how the markets are reacting. But until then, stay safe, stay COVID-19 free, and at least enjoy time in your home with your families. Take care.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.